studying your last two. I swim med when they turned in. The styren down to mute. And can learn the pole that sunk he died.
Before we can calculate foreign tax credits or complete Schedule 21, we first need to understand a much simpler question. What is foreign income? Many new tax preparers assume that foreign income only applies to large multinational corporations. But in reality, even small Canadian corporations can earn foreign income. And whenever foreign income exists, additional tax reporting considerations may arise. Let's begin with the basic definition shown on the right side of the slide. Foreign income is income earned outside Canada. That's the simplest way to think about it. The key factor is not where the corporation is located. The key factor is where the income is earned. A Canadian corporation can remain entirely based in Canada and still earn foreign income. That's why the world map is shown in the center of the slide. Barnes Dentistry is a Canadian corporation, but income can flow into the corporation from many different countries around the world. Whenever income originates from another country, it may be considered foreign income for Canadian tax purposes. Now let's look at the four common categories of foreign income shown across the bottom of the slide. The first category is foreign interest income. Imagine that a Canadian corporation holds money in a U.S. bank account or owns foreign bonds. Those investments may generate interest income. Even though the corporation is Canadian, the interest originates from a foreign source. As a result, the interest may be considered foreign income. The second category is foreign dividend income. This occurs when a Canadian corporation owns shares of a foreign corporation. For example, Barnes Dentistry might own shares of a large U.S. public company. If that company pays a dividend, the dividend is generally considered foreign dividend income. This is one of the most common forms of foreign income encountered by Canadian corporations with investment portfolios. The third category is foreign rental income. Suppose a corporation owns a rental property located in another country. The rent collected from tenants may be foreign income because the property generating the income is located outside Canada. Even though the rent eventually reaches a Canadian corporation, its source remains foreign. The fourth category is foreign business income. This can arise when a Canadian corporation sells products or services to customers in another country or carries on business activities outside Canada. The income earned from those activities may be considered foreign business income. This category is particularly important for corporations involved in international trade or cross-border operations. Now let's return to the center of the slide. Notice that all four income sources flow toward the Canadian corporation. This visual reinforces an important concept. The corporation itself is still Canadian. What changes is the source of the income. The income originates from outside Canada and flows into the corporation. This distinction is critical because many international tax rules are based on the source of income rather than the location of the taxpayer. Now let's look at the notes beneath the definition panel. Foreign income may be taxed by another country. For example, a foreign government may withhold tax on dividends or interest before the money is paid to the Canadian corporation. This is one of the reasons foreign income is so important from a tax perspective. Foreign taxes paid may eventually create eligibility for a foreign tax credit. And that brings us back to Schedule 21. The entire foreign tax credit system begins with identifying foreign income correctly. If foreign income is not identified, then foreign taxes may not be reported properly, and potential tax relief could be missed. Notice the message at the bottom of the slide. Foreign income is identified by where the income is earned, not where the corporation is located. This is one of the most important concepts in international taxation. A Canadian corporation can earn Canadian income, foreign income, or both. The classification depends on the source of the income. The key takeaway from this slide is simple. Foreign income is income earned outside Canada. Common examples include foreign interest income, foreign dividends, foreign rental income, and foreign business income. These income sources may be taxed by another country and may eventually create eligibility for foreign tax credits under Schedule 21. Understanding what qualifies as foreign income is the first step in understanding all foreign tax reporting within the T2 return. In the next step, we'll see how foreign income first enters a corporation's accounting records and financial statements before it ever appears in the T2 return. Now that we understand what foreign income is, let's look at what happens when a corporation actually earns that income. One of the most important concepts in tax preparation is that tax returns do not start with tax schedules. They start with accounting records. Before foreign income ever appears on a T2 return, it first becomes part of the corporation's bookkeeping system and financial statements. Let's begin on the left side of the slide. Here we see several examples of foreign activities that generate income. A corporation may sell products or services to customers in another country. It may own investments in foreign corporations, or it may own rental property located outside Canada. Each of these activities generates foreign income. At this stage, the income has been earned, but nothing has been reported for tax purposes yet. The first step is recording the transaction in the accounting records. Now move to the center of the slide. This is where the accounting system comes into play. Every foreign income transaction must be recorded just like any other business transaction. The corporation enters the income into its accounting software, general ledger, and revenue accounts. Notice the examples shown on the accounting screen: foreign interest income, foreign dividend income, foreign rental income, and foreign business income. Each category is recorded as revenue within the corporation's accounting system. This is an important point. Accounting records do not separate income simply because it is foreign. Instead, the income is recorded and becomes part of the corporation's overall financial results. As more transactions are recorded, the information flows into the income statement. The income statement summarizes all revenues earned during the year. That includes both Canadian income and foreign income. This brings us to one of the most important concepts on the slide. Foreign income becomes part of accounting income. Notice the highlighted box near the bottom of the accounting panel. All income, whether Canadian or foreign, flows into the income statement and contributes to the corporation's accounting income. In other words, foreign income is not excluded from the financial statements. It is fully included in the corporation's reported financial results. Now let's move to the right side of the slide. At year-end, the corporation prepares its financial statements. The income statement now contains all revenue sources earned during the year: Canadian income, foreign income, and any other business income. Together, these amounts create accounting income before tax. This accounting income becomes the starting point for preparing the T2 return. Notice the CPA reviewing the financial statements. This represents the transition from accounting to taxation. The accounting records have already captured the income. Now the tax preparer begins using those financial statements to prepare the corporate tax return. Let's look at the important concept panel. The message is simple but critical. Foreign income is reported in accounting income before tax schedules are prepared. This is a concept that many beginners overlook. Schedule 21 does not create foreign income. Schedule 21 simply uses information that has already been recorded within the accounting system. The foreign income must exist in the financial statements before any foreign tax credit calculations can occur. Now follow the flow diagram across the bottom of the slide. The process begins when foreign income is earned. That income is recorded in the accounting records. The accounting records produce the financial statements. The financial statements determine accounting income. accounting income flows into the T2 return, and eventually, foreign tax information may be used in Schedule 21 for foreign tax credit calculations. This sequence is extremely important because it shows the correct order of events. Accounting comes first. Tax schedules come second. The message at the bottom summarizes the entire slide. Foreign income enters the T2 through the corporation's financial statements. That's the key idea. The T2 return does not create income. It reports income that has already been recorded through the accounting process. The key takeaway from this slide is simple. Foreign income follows the same accounting pathway as any other corporate income. It is recorded in the corporation's books, included in the financial statements, becomes part of accounting income, and then flows into the T2 return. Only after that process is complete do foreign tax schedules, such as Schedule 21, come into the picture. In the next step, we'll follow foreign income through the entire T2 reporting process and see how it ultimately connects to Schedule 21 and the foreign tax credit calculation. We've now learned what foreign income is and how it first enters a corporation's accounting records. The final step is understanding how that income moves through the T2 return and ultimately connects to the foreign tax credit system. This slide brings the entire process together. Let's begin with Stage 1 on the left side of the diagram. Everything starts when the corporation earns foreign income. This income can come from many different sources: foreign interest income, foreign dividends, foreign rental income, or foreign business income from international customers. The important point is that the income originates outside Canada. At this stage, the corporation has earned the income, but no tax reporting has been completed yet. The next step is Stage 2. The foreign income is recorded in the corporation's accounting records and included in the financial statements. Just like Canadian income, foreign income becomes part of the corporation's income statement. Notice the financial statement shown in the diagram. Foreign income is not separated from accounting income. Instead, it becomes part of the corporation's overall financial results for the year. This is where the tax reporting process begins. Now move to Stage 3. The financial statements become the foundation for preparing the T2 return. The corporation's accounting income flows into the tax return. Foreign income is now included within the corporation's reported income for tax purposes. At this stage, the T2 return recognizes the foreign income as part of the corporation's taxable activities. But we are not finished yet. The next step is critical. Stage 4 is foreign taxes paid. In many cases, the foreign country will impose tax on the income before it reaches the Canadian corporation. For example, a foreign government may withhold tax on dividends or interest, or the corporation may directly pay foreign income tax to that country. The tax receipt shown in the diagram represents proof that foreign tax has been paid. This information becomes extremely important because it creates the possibility of Canadian tax relief. Now we arrive at Stage 5. Schedule 21. This is where foreign income reporting and foreign tax reporting come together. Schedule 21 receives two key pieces of information: the foreign income earned and the foreign taxes paid. Using that information, Schedule 21 calculates the foreign tax credit. Think of Schedule 21 as the bridge between foreign taxes paid and Canadian tax relief. Without Schedule 21, foreign taxes paid would not automatically reduce Canadian tax. The schedule performs the calculation and determines the allowable credit. Next, we move to Stage 6, the foreign tax credit. Once Schedule 21 determines the allowable credit, that amount is claimed on the T2 return. Notice the green shield in the diagram. This shield represents protection from double taxation. The corporation has already paid tax to another country. Canada recognizes that payment and allows a credit to reduce Canadian tax payable. This is the key purpose of the foreign tax credit system. Finally, we arrive at stage 7, the final outcome. The income has been reported correctly. Foreign taxes have been recognized. Double taxation has been reduced, and a fair tax result has been achieved. The balance scale shown on the slide is an excellent symbol of the final objective. The Canadian tax system aims to balance international taxation by ensuring that taxes already paid abroad are considered when calculating Canadian tax. Now let's look at the mental model on the right side of the slide. This summarizes the entire reporting process. Foreign income is earned. It enters the financial statements. The financial statements feed into the T2 return. Schedule 21 processes the foreign tax information. A foreign tax credit is calculated, and Canadian tax is reduced. If you can remember that sequence, you'll understand the foundation of foreign income reporting. The panel at the bottom explains why this process matters. Proper reporting ensures that foreign income is recognized correctly. It allows foreign taxes paid to be recognized. It helps prevent double taxation, and it supports international investment and business activities. Notice the message in the final banner. Foreign income must first be reported before foreign tax credits can be claimed. This is one of the most important concepts in this entire section. Schedule 21 cannot create a credit unless the underlying foreign income has already been reported properly. The reporting comes first. The credit comes second. The key takeaway from this slide is simple. Foreign income follows a complete reporting path. It begins with income earned abroad, flows through accounting records and financial statements, enters the T2 return, connects to Schedule 21, generates a foreign tax credit, and ultimately reduces Canadian tax payable. This complete reporting flow forms the foundation for all foreign tax credit calculations. And now that we understand the entire process, we are ready for the next step, a detailed Schedule 21 case study, where we'll apply these concepts using real numbers and perform an actual foreign tax credit calculation from start to finish.